Well, thanks so much for tuning into this very special coverage. If you bought LIC, the stock in the IPO, the question is on everybody's mind as to what should you do. But frankly, that's not alone. Life insurance companies in general have underperformed the Nifty index in the last 6 months, largely due to concerns relating to rising interest rates and moderating individual protection growth, along with some expectations or hypothesis of how lower non-par sales would be a reality in a rising rate scenario. So therefore, how tough would it be for the stocks to regain their lost glory in the falling market? What should you do if you are an investor in the LIC IPO or otherwise? We've got two experts to speak about this. Gurmeet Chadha, co-founder and CEO of Complete Circle Capital, and Mayuresh Joshi, head of equity research at William O'Neill India. Gentlemen, both of you, thanks for joining in. Hope all is well. Gurmeet, let's start off with LIC, then broaden the conversation to a larger insurance space as well. First, for a lot of people who are invested in the LIC stock, either during the IPO times or maybe at a slightly lower level post-listing, what should they do?
So, Neeraj, I think there are a couple of things which have happened. One, obviously, is the broader market sentiment, right? In general, related to, especially to large IPOs. India doesn't have a great track record when it really comes to large IPOs, right? And so I think there are two broad concerns here. One is how the embedded value movement will happen, because the embedded value came just before the listing due to bifurcation of, and it was a little technical for most of us to really grasp of. Also, if you see within the embedded value, for LIC it grows 1.5% only because of VNB, which is the new business, which for viewers' understanding, versus let's say 8-10% for the private peers like HDFC, SBIs of the world. So how the embedded value will move, I think, is something which the market would want to take more time, considering that this has been derived very differently vis-a-vis the way we calculate an embedded value for viewers against like book value for banks, right? That's how you value it. And currently at this price, it's 0.9, which obviously optically looks very good. Second is the inherent nature of the volatility in embedded value, because for example, in non-par, 35% of the assets are equity, and markets have been very volatile, right? And the second concern is on the growth. So LIC, for example, the AP growth has been lower than peers. Their VNB margins have been at around 9-10% versus let's say 25% for private peers. So I think these are some of the concerns market has. But I think you will see whenever the company lists, there is improvement in underwriting standards. There is improvement, in transparency in which way you disclose. For me, I think the LIC has a lot of strengths, and I think current valuation looks obviously undemanding. I would say. I would not say very outright cheap, and one can gradually look at it's not one stock which is going to give you supernormal returns. But if you are looking for something which is steady, value style of investing, it may fit in the bill. The process has to be more long drawn, and I'm in general pretty constructive. I think a lot of the headwinds are reversing for insurers. I see industry AP growth at 14-15%, with probably private peers doing better.
Okay, with probably private players doing better. Then the question remains, why LIC? And I'll come back to you, Gurmeet, on that. Mayuresh, some of these growth concerns for LIC vis-a-vis the private players were known pre-IPO as well. So that people who invested in the IPO, was that a wrong decision itself? And even if that were the case, are the valuations, as Gurmeet said, undemanding and therefore good to buy the stock? Or would you choose other insurers, or would you choose a completely different sector?
Morning, Neeraj. Morning, Gurmeet. To add to what Gurmeet had stated, Neeraj, very clearly, I think two things stand out for any life insurer player. So one of the aspects is the product mix. And clearly, I think, as you rightly pointed out, at the pre-IPO stage itself, we all knew that the protection in the non-participating mix of LIC compared to the other private players is on the lower side. So I think as a group policies still dominate, and therefore I think the value of new business margins are relatively lower compared to the private bank. So LIC's VNB is close to 9-10% compared to an HDFC Life at 27 and SBI Life at 21. Now, two things happen, and what Gurmeet clearly mentioned in terms of embedded value, how your product mix is and what kind of growth dynamics come out. So if your product mix, as LIC has clearly been demonstrating, on the lower side because of lower amount of share in terms of non-participating and protection. The VNB margins are on the lower side, and therefore the growth in these products obviously do not aid VNB margin growth. Though the revenue growth in terms of APEs, both on an individual and a group scale, have been phenomenal because of their sheer presence and their wide distribution mix. But overall, I think the embedded value gets impacted because of the increase in ROE EVs gets impacted because of an increase in VNBs and growth, which is clearly lagging in the street. And therefore, the pricing of the IPO and the valuations that they put in were reasonably fairly put in. Is the management trying to put forth a digital initiative, increase product mix? Yes. And will it take time? Yes. So I think you need to have patience for that. And whether that will play out in the next few quarters will be interesting. But at this stage, I think it's a wait and watch.
It's a wait and watch. So don't buy into LIC, Mayuresh, according to you. Buy into any of the other insurance companies because frankly, one, that they have not performed for a really long time. And therefore, just because the stock has underperformed doesn't mean that it will start performing, any of the insurance names per se. And, multiple other statistics also point that there are some chinks in the armor still. I buy Gurmeet's point that things are improving, but have they improved enough for you to take a bet, Mayuresh, on the insurance stocks per se?
No, absolutely. Point taken. I think things definitely are improving, specifically after the 3 waves of COVID that we've probably seen. I think the first 2 waves, you've seen significant claim hits happening for insurance players. And that probably took a dent in terms of their bottom line growth. But if you probably look at the APEs or the overall mix in terms of how premiums have been growing, both on an individual and a non-individual scale as well, I think they've been growing quite decently even during the COVID phase. Now, the existential need in terms of propping up your insurance needs in a post-COVID world are obviously going to go up. Your COVID claims are going to go down, which basically means that profitability is going to move up significantly. And if you probably look at the OPEX stats for all the players stacked together, Neeraj, LIC probably has one of the lowest in terms of the operating expenses. The commission ratios will obviously be high because of the sheer number of policies that they sold. But again, I think the sheer pass-through, as more policies get sold and operating leverage gets played out, balance sheet dynamics of insurance players obviously look very, very attractive in terms of a compounding story over a longer period of time. Whether to enter to your other question at this point of time, as per O'Neill, we clearly maintain our stance that price strength probably needs to come through, both for HDFC Life and SBI Life. So in our opinion, I think another 10-15% move surely in basis of price will probably take care of supply issues. Maybe investors can be a tad bit late, if I would call it, on a 10-15% move, but at least there will be some sort of surety that the worst is probably behind all these things.
Okay, so you're waiting for the trend to change before you try and go out and buy them, right? Okay.
Yes.
Gurmeet, I heard you say some of the headwinds are receding, but if you just look at the mortality claims paid by all the life insurance players, FY22, while the percentage growth was lower than FY21 mortality claims, was still very high. So if indeed COVID was a bit of a non-issue in the second half of FY22, and if mortality claims continue to be so high, what assures us that they will come off in FY23? And therefore, would it be prudent to wait and watch as opposed to buy even the private life insurers?
So yes, I think some of it is in the price. I think the high mortality rate, if you see, and market tends to discount negative news. We've seen that not only the insurance, and insurance is a complex business. It looks very easy optically, but it's a business where you write policy now, hope to make profits over the next 10, 15, 20 years, taking a call on interest rates, taking a call on mortality. So it's very, it's a forecasting business, so my view is, I think looking at the new variants, obviously, of COVID, which has come, I'm not a scientist, but looks like that mortality rates are coming off. And against FY22, I think FY23 should be relatively better, unless you see another Delta kind of a variant. And also, if you see the premiums which somebody like HDFC Life was getting vis-a-vis, that is also diminished. So from 4 or 5 times embedded value to, let's say, roughly about 2.83 times now, right? So it's about, let's say, 30, 35, 36,000 crores. You take current market cap, it's not as demanding as, and also the fact that others like, as Mayuresh made the point, SBI has caught up. So if you see last year, for example, the AP growth was 15-16%. For the industry, SBI Life was 22%. Their VNB margins improved. VNB margin is nothing but I write a policy today, and let's say if it's 25 rupees, 25% is my margin, I'll make 25 rupees over the policy. I think one thing which you have to be very careful here is not as much mortality, is how you are underwriting. So HDFC is more prudent because they don't want to, dilute their underwriting standards, especially in, individual protection. It's like lending, Neeraj, right?
Yeah.
You can lend as aggressively as you want, which is what we have seen with NBFC. So HDFC Life is slightly prudent there, and there is some demand side challenges because post-COVID, certainly even the conversion rates has dropped. So I think I would watch out for three variables. One, as I said, is AP growth. Second, ability of the private insurers to keep growing, at VNB in 20s, with VNB margin closer to 25, 26, which we are seeing now. And persistency ratio. I think that one metrics you need to track, because as I said, if my policies don't cross 5 years in terms of premium, all that calculation goes for a toss. So
which has always been 60%, right? It just doesn't budge from there, right, Gurmeet?
Yeah, so HDFC is like 57% now. I think private, and LIC was like 46-47%. So we need to see this both 13-month and 61-month persistency ratios over a period of time. And I think how this non-par share goes up, how balanced is the product. For example, I'll tell you, SBI, I was watching their dependency on SBI coming down, their growth in agency channels. So even the distribution mix has improved. And Neeraj, there 60% SBI branches now do insurance. So if you, so you have to take into account a lot of parameters.
Sure.
So I think the industry can grow at 15-18%, clock that 18% ROEV, which is return on embedded value. Makes sense to add, considering correction and underperformance in the last 2 years.
Okay, so essentially we have 1 minute each for both of you, Gurmeet. Maybe add LIC, but better to add, according to you, is HDFC Life and SBI Life. Did I hear you correctly?
Yes, so I'll prefer HDFC Life and SBI, even some of the non-life insurance. Although we are still on the life, So I think overall, I think the industry should grow with protection gap getting bridged with every successive year.
Okay, Mayuresh, to you, people don't necessarily are fund managers like Gurmeet, so they don't need to have insurance in their portfolios. Would you recommend insurance at all, or would you recommend other sectors?
No, so to a large extent, I think it's a growth.
60 seconds, Mayuresh.
Yeah. So I think, as I said, price strength on these stocks, SBI Life, HDFC Life, maybe 15% moves. But other sectors like a bit of fertilizers and global agrochemicals, I think they look very interesting.
Okay, great. So Mayuresh also avoiding LIC. Gurmeet is saying maybe you could add a little bit, but Mayuresh still avoiding LIC. Mayuresh avoiding insurance altogether. Gurmeet believing HDFC Life and SBI Life probably give you a chance, along with some of the other non-life insurance players as well. Request to everybody who's listening to this, do your own due diligence before you decide to go out and buy. But for a lot of you who are trapped in LIC, I think the larger inference seems to be that this is not the time to add on to a losing stock. Maybe you can switch to some of the other insurance players, or switch out of that into some other sectors completely. Gurmeet, Mayuresh, thank you so much, gentlemen, for sharing your time today. Much appreciated.
Thank you so much.
Viewers, thanks for tuning in.
Thanks, Neeraj.